An inevitability in the world of investments is a shift away from polluters to more sustainable companies. It's been happening, albeit gradually, for years. And now the pace of that transition is accelerating. Outdated investment portfolios that don't move with the times will be left behind. In this video, what the latest move from dirty to clean investing could mean for your returns over the next decade. I'm Martin Bamford, a chartered financial planner, and I'll admit that I was slow to move to sustainable investing. It took me until about a year ago to recommend wholesale changes to the portfolios that I'm ultimately responsible for managing. That's around £400 million worth of client money, where we introduced a sustainable investment overlay to our portfolio construction process. But others are slower. Despite what feels like a degree of inevitability in this shift from carbon to low carbon investing, that pace is starting to pick up. I'm looking at this today after reading in The Guardian that the UK's largest pension fund is moving £5 billion worth of its assets to an equity index designed specifically for a transition to sustainable companies. The University's Superannuation Scheme, or USS, which is responsible for managing pension funds for British academic institutions, is introducing this climate tilt to its money, allocating it to companies that are making strides towards lower carbon emissions. The move will mean that the carbon emissions associated with that £5 billion worth of assets are immediately cut by 30%. And over time, the reduction in emissions will grow. While £5 billion is only a small part of the £82 billion worth of assets managed by the USS for its 470,000 members at 330 universities, it is a signal of intent, and more is likely to follow. USS members are placing the fund under growing pressure to decarbonise, and that's in keeping with pressure being placed on other UK pension funds. The £5 billion pot is being moved to Legal and General Investment Management, who are going to invest it in line with a climate transition index developed by a German company called Solactive. So index tracking investments, money that was previously run for the USS by BlackRock in line with MSCI indices. It's reported that, as well as being greener, the move is going to reduce the associated management costs. Along with that 30% day one cut in emissions associated with the investments, Solactive is targeting a 7% annual fall in portfolio carbon emissions. And I like that approach. It sits very comfortably with our philosophy on sustainable investing, which is to go for progress, not perfection. It's unreasonable to expect a perfect portfolio on day one, but we should all be monitoring progress towards net zero within our portfolios, and of course other sustainable investing traits too. Simon Pilcher, who is the chief executive of the USS Investment Management, which manages that pension scheme's money, said, "We think this is a significant first step. We are committed to the ultimate decarbonisation of the total assets." Pilcher continued, "Our conviction, though, is that for that total decarbonisation to happen, it is the underlying companies and the way in which the world operates that have to change. So we are not going to exclude our way to net zero. We have to help the businesses in which we invest." That's an important point to understand. This style of investing is often referred to as ESG, or environmental, social and governance investing. And that last part, governance, is about using your clout as a shareholder to encourage businesses to make the right choices. While a business might be a polluter today, shareholder advocacy can help place gentle, or indeed not so gentle, pressure on the management to make positive changes. In other words, as an investor, you have more options than simply saying, "See ya, buy," and selling your stake and investing in something that's already green. You can be the change that you want to see. But when that change doesn't materialise, despite requests and pressure for it to happen, investors can and they do sell. Last week, the Church of England pension scheme announced that they would sell some shares in 28 fossil fuel producers that had not provided clear evidence of plans to reduce emissions. And a spokesperson for the USS pension scheme said that this £5 billion move was just the beginning, with more of the portfolio expected to move to climate-aware indices in the future. It's fair to say that the USS pension scheme has come under pressure from some members to divest from polluters. Members are particularly concerned about the stakes held in the highest polluting companies, the likes of Shell and Heathrow Airport, two companies responsible for a significant amount of carbon emissions. There's a campaign group called Divest USS, and they are pushing scheme managers to do more to vote at board meetings where they hold the shares and the voting rights to pass climate-focused shareholder resolutions. And that, again, is governance in practice. Paul Kinnersley, who's an emeritus professor at Cardiff University and also a coordinator at that group, Divest USS, highlighted the fact that USS members included large numbers of climate scientists and other academics who would probably favour rapid divestment. He said any shift by USS to decarbonise or clean up their investments is obviously a step in the right direction, but they've been slow about changing, and they've been slow about sharing detail on the target of net zero by 2050. We're welcoming it, but there's still a long way for them to go. Keep an eye on this story. Moves like this by large institutional investors often lead the behaviour of smaller retail investors. If big institutions are flogging off their holdings in high carbon businesses, that will naturally reduce the price of those shares. Arguably, the share price in some polluters is being artificially inflated right now by the post-COVID economic recovery and by surging wholesale gas prices. The long-term pressure on these companies is ultimately down because fewer investors, big or small, will want to hold those shares as awareness of sustainability increases. Will you be following the USS pension scheme and others into a transition to net zero to sustainable companies? And if not, why not? What do you think will ultimately happen to the share prices of unsustainable companies who are facing top-down and bottom-up pressure to achieve net zero? Let me know what you think in the comments below. Are you already part of our subscriber community here on YouTube? If you are, a big thank you for supporting my videos. If not, do press that little red subscribe button, become part of our community. It's completely free and you'll never miss an episode. Thank you for watching this video. Until next time, I'm Martin Bamford, and remember, when it comes to your money, the more you know, the faster it can grow.